Hello and welcome to another edition of the Jerroms Miller Tax Hour, a part of the Jerroms Miller Knowledge Hub where we aim to encourage collaboration between like-minded professionals in the tax industry. I'm your host, Nick Wright, Director of Jerroms Miller Specialist Tax. I've got a bit of a different episode today. We're talking less technical and more about client experience. So I'm very pleased that William Dunne has agreed to join me. So thank you for joining me, William.
Pleasure.
We helped William on a recent management buyout structure. And I'm also joined by Jamie Ellis, independent financial advisor with Jerroms Financial Planning.
Thank you.
So where to start? I was going to talk about sort of where did you start? When did you start thinking about doing a sales transaction? Was an MBO your first type of transaction? And kind of actually, what do we need to do to prepare for a sale before we even get to the transaction itself? So to start with, when did you start thinking? Because this is effectively your retirement, isn't it?
It is. Yes.
Have you done any transactions before? You've run Think Idea Limited for years.
For 30 years. So I guess in that period, there's obviously been a whole series of business transactions. But there's obviously no playbook in the general day-to-day experience of being an MD and running a company for the ultimate transaction, the ultimate exit transaction. And as for when that seed is sown in your mind, I don't think there is one single occasion. I think it's just something that starts to form, and you get to a point where you feel as though the moment is right. I think through my career, there have been several opportunities where there have been offers for my company, but that has never felt the right thing to do.
Yeah.
Always the right thing felt to be able to come up with something whereby looking after the team and after the business and after the mortgages of all of the employees was something that was paramount for the kind of continuance of what it is I've started. So therefore, it needed to be the right time and it needed to be the right mechanism. And that kind of thought process evolves.
Yeah, definitely. I mean, that's one thing that struck me when we started talking was it was clear this wasn't just about your exit. This was very much about, okay, well, you've had a team behind you for a long time. You know, especially the team that ended up taking over, they've been with you for all of them over a decade, I think.
Indeed.
So it's not always about getting the best deal on a third party sale. It's about looking after the people who have kind of helped you get to the position that you can kind of think about an exit, I guess.
Yes, it's not about some kind of sort of great legacy for me. It's about all of those relationships that can continue and provide the right environment for them to continue.
Yeah. So, as we said, you ended up selling to 4 different shareholders. At what point did you start to think these are the people who are going to take over? These are the people who I need to kind of push into this, or did it naturally happen? Or did you kind of get to the point where I think I'm ready to retire, and these are already people who are ready to take over, kind of thing?
I think over a period of years, I'd already introduced a developing management structure, which then, as the idea of this transaction and impending retirement took hold, I then started to look at, okay, how would you ensure the continuance of idea, and within that team, is there enough experience in terms of being able to continue to be able to bring in new business. I think that as I've been a majority job winner, obviously my departure would leave a gap. Therefore, that needed to be filled. So whilst there were three obvious candidates to take over, it also needed another additional capability to be brought in order for me to feel confident that the stage was set for it to move on.
Yeah.
So there were three, and then, as you will remember, it was a combination of an MBO and an MBI.
Yeah.
Just to make it more interesting.
Yeah. Yeah. So just to explain some of the terminology, management buyout is typically where we talk about the existing management team in the company acquiring shares. It doesn't have to be on an exit event, but in this case it was. And a management buy-in, an MBI, is where someone external comes in. So we had a combination of the two. And as you say, that was a good team. You'd worked with all four individuals, even though one individual was external at the time.
Yes, they had previously worked for us, gone off to set up their own business, and then it was a case of bringing that business back in again. So yes, they were all known quantities, all embedded in the kind of ethos of the company.
And that's quite important, isn't it? Yeah. So obviously you've built up a business. There's various different ways you can do succession planning. As I already said, you can do third-party sales. You could sell to someone who's just going to asset strip and just take the bits that they want. Whereas
they will very quickly probably snuff out the very flame that you've been nurturing for all of these years.
And to be fair, if you've spent 30 odd years in a business, you don't just want to see it stripped out and stripped for parts, do you? So clearly, you thought these four individuals were people who could take it forward and help incentivize and help push the remainder of the staff and the workforce. So
indeed,
it's nice. It's nice when people have that view rather than sometimes people are just looking to get the most money out of a deal that they can possibly get from whichever party is willing to offer it. So I talked to Jamie for a bit. So we've obviously talked just now about how you get to a position of having a management team or somebody to take over and having the confidence in them. From your perspective, Jamie, within a financial management position, normally on an exit, someone is going to have a certain level of cash. Sometimes it's huge amounts of cash that they've never had, or sometimes it's relatively small, but it's still a decent chunk for their retirement. And often, especially if someone's run a business for 30 odd years, they've lived off a reasonable salary for that time, but now there's more money in the pot than they had before. So at what stage do you think would you like to come in to speak to someone like William?
Yeah, and obviously, William, this is our first time meeting today, so just like to make that clear. So really, being linked with Jerroms, we work with a whole range of small to medium-sized business owners at all stages of the journey, from incorporation and all the way through to exit. I think the beautiful part of our role is, even when typically from an accountancy perspective, where the business draws to a natural conclusion, is wound up or is sold, and that relationship may end, we, looking after the individuals and their personal and family affairs, deal with them all the way through their lifetimes, and then the intergenerational wealth transfer, etc. But we work with business owners really on a number of reasons. First is to protect what they've got. And that's not just, their personal assets, but that may be the business. So some unforeseen risks that we see with businesses is where there's joint shareholders, but there's no shareholder protection in place. And we've, come across some unfortunate scenarios where one shareholder has passed away, and then, the shares automatically are received by the wife, which then can cause implications within the business, and the business doesn't then have the cash to repay the wife. We can, we also help assist with key person insurance as well. So if you've got, a significant profit center within your business, or somebody who is there that's really amassing helping the business on a day-to-day basis from a financial perspective. It's about insuring them. So before any financial plan comes into place, it's about ensuring there are adequate foundations and protections.
Yeah.
As you then say, it's in conjunction with the accountant, ensuring that they're only taking what they need from the business to support their lifestyle. And a lot of what we do is company pension planning. So company pension planning, so contributions into a director's pension is an allowable business expense, which can reduce the company's corporation tax bills on an ongoing basis. But it's also important, as a business owner, William, you're taking all of these risks in the business from day to day. But it's also important that directors and shareholders realise to pay themselves first. And that's where, pension contributions can provide a tax efficient means of extracting company wealth over a period of time until maybe an exit is on the cards as well.
So what you're saying is I should have talked to you first.
Well, I didn't.
It's too late now, isn't it?
He didn't want to say it in that many words, but yes.
Yeah, yeah. So yeah, it's all about, and the other area where we get involved is helping individuals and business owners realise how much is enough. What value do you need to get for your business to maintain or sustain the current lifestyle that you're living? Because not every business owner enjoys what they do. Not every business owner still has the drive, the hunger, the excitement that they once had. And so if we can show them through our sophisticated software and our experience that actually they don't need to maximize the company's value by sale to a third party and maybe doing an MBO, which results in less proceeds but gives them the outcome that they want.
Yeah.
Well, you can absolutely do that, and you can still achieve everything that you've wanted to achieve, and everybody's different in what they want from life and
absolutely.
exit.
So in terms of, obviously you said pension planning is a big one.
Yes.
You can't just put as much as you like into a pension generally, can you? There's limits.
Yeah.
Obviously the lifetime allowance actually, when was that last withdrawn effectively, wasn't it? Was it the last budget or the budget?
Well, the lifetime allowance was scrapped effectively, but they've introduced a new regime which effectively each individual can amass £1,073,100 in a pension fund. There's various tests which go on. But the key point for business owners is for company contributions, the annual allowance is £60,000. You can also carry back 3 tax years, assuming that you have been a member of a UK registered pension scheme in those years. So the annual allowance in the current year is 60. Last year it was 60, and the 2 years prior it was 40. So that's potential scope to make a £200,000 company contribution. But the important thing is, for personal contributions that you make yourself from tax-paid income, your ability to fund a pension is capped at your UK relevant earnings.
Yes.
And so that is only salary. That doesn't include dividends or rental income. And so business owners have a very tax efficient way of extracting company wealth.
Yep.
And it's about protecting yourself, because if anything were to happen to your business, that fund is then ring fenced from creditors, insurance risk, and that can be used at another time.
And as you say, because you're doing annual contributions, the sooner you start that, because £200 is still a decent amount to put in as a lump sum.
Yeah, definitely.
But if you've been doing this for 10, 20 years anyway, then you've been building that up. So
well, typically what we do is we will, when we're working with business owners, we will establish a company pension account with them. So an account that can receive company contributions. We'll typically set up a regular monthly contribution, assuming that there's sufficient cash flow within the business. But then in conjunction with the accountant, we'll always set a reminder a month or 2 months before the year end to get the books up to date, to check what the likely profits are going to be, and then we can review the feasibility of a lump sum year end contribution.
Yeah. So as I said earlier, it's a bit too late for me, because even before I even thought about retiring and this ultimate transaction,
Yeah.
I actually cashed in all my pensions and put them in and bought a property with them. So that sounds like it's probably the worst thing I could have done. So, as I said earlier, it's a shame I probably only just met you, but it's, that ship has sailed, I think.
Well, I think this just comes back to the point: the sooner that you seek advice on all aspects and any big financial decisions that you make, the more it can benefit you in the longer term. But it's not to say that there aren't other things that can be done, and actually it's about reviewing everything holistically. I mean, from our perspective, it's all about reducing the effective rates of tax while also trying to maximize and retain the purchasing power of your proceeds or a client's wealth, because inflation has run rampant over the past 3 years. I think the true inflation figure has been 33% over the last 3 years, and so it's very important that your monies and wealth are structured optimally, not just to grow and to grow for money's sake, but to try and protect it in real
I think
terms.
there's a couple of things you've said. The fact that you need relevant earnings. So I haven't done these calculations for a long time because I do transactional stuff now, but when a tax advisor or an accountant is doing a calculation of things like of salary versus dividends, you also need to factor in things like if you're going to make a pension contribution, you can't just say, well, we'll pay a really low salary and pay the rest as dividends, because they might want relevant earnings. What's good about being a business owner is you have a lot more control over something like that other than just an employee. So as a business owner, you can say, well, so for the relevant earnings point is a personal pension contribution, isn't it?
Yes, correct.
So the company is not restricted by that.
No, it's not.
They are restricted by the, what figure did you say, the 200,000 if you were to look back?
Yeah, with the annual allowance and
yeah.
the carry forward position. And I mean, we can come on to this later, but the other core point is when you've got the business is obviously worth a value, and there will be at some point a transfer of that value from the business, which benefits from business property relief. So it's outside of your estate for inheritance tax purposes, assuming it's a trading company. To all of a sudden, when people sell their business, the value is then inside of your estate for inheritance tax purposes.
Yeah.
Now, under current legislation, pension funds are considered outside of your estate for inheritance tax purposes. So that is another reason why it's so efficient. But that's also something that we typically speak to people who've recently sold their business about what their objectives are.
Yeah.
All of those things.
Yeah, because what we very commonly see when we're doing transactions and sales sort of on retirement is business owners don't necessarily need all of the money they might be making, so they don't want to pay income tax on it, so they leave it in the company, which means they've got a huge, not always huge, but they've often got a decent cash sum, and saying, well, actually, instead of taking that out as a capital gain, why don't you pay 200 grand into a pension to start with? Those kinds of conversations, which are a bit more, a bit broader than just, as a tax advisor and advising William as I did, just sell the company and this is one way of doing it and this is how you do it as tax efficiently as possible, kind of thing.
Definitely.
So there's a lot to think about, isn't there, before we've got to the point where we're selling and this is who we're selling to and this is when we're going to do it. So yeah.
How long would you say the overall process took you, William, from
me making the decision that it felt time to conclusion of the deal? I think it's probably 18 months or so, or maybe a little bit longer, but a lot of that period is mulling it over in your mind. That period is not, talking to people like yourself or accountants or colleagues, or most of the time most of that 18 months, he's probably just taking the dog for a walk and thinking it through. I think actually the period of employing yourself, Nick, was probably more like 3 or 4 months, I think, probably.
Yeah, I think that was about
So there's an awful lot, in my mind anyway. I mean, it's obviously different for everybody.
Yeah.
Approach these things differently, but in my mind there's an awful lot of just circling around in your mind and eventually kind of honing in on what you think a solution may be, a solution that's best for everybody involved.
Because it's a big decision, not obviously for you in your situation. It was I'm going from I've worked in this business for 30 years to I'm doing a full retirement. So just whether you retire is one decision, and then what you do with the company is the next decision. So yeah, it's huge, isn't it, in the grand scheme of things? That
it is huge, yes, but it's in the general scheme of things, it's probably it's not like solving Gaza or any of the other major events in the world, is it?
No.
It's relatively parochial, but it is I suppose quite seismic for the individuals.
Personally, yeah.
And I think part of the exercise is trying to ensure that it is as seamless as possible for everybody's benefit, not least your employees who've been with you and worked alongside you for many, many years, ensuring that it is seamless. There are no shockwaves. The company doesn't miss a beat.
Yeah.
As it moves from transitions from sort of one period into another.
Yeah, because it's in essence the customers are more interested in just getting the service, aren't they? So they're not going to be giving you any favours just for the
they're interested in the fact that something is in place and they're going to get the same level of service, and they're interested in that seamlessness as well. And those are the kinds of considerations you're making whilst you're walking the dog and trying to work out what is the best way of being able to do this.
Yeah, so there's a lot of moving parts that. And that's exactly why I wanted to do this podcast, because we normally do technical tax stuff, which, as a tax nerd, that's great to talk about. But
if you're going to talk about that for the next half hour, I probably wouldn't be sitting here. No.
That's why I gave you a coffee before we started. No, but what a lot of tax advisors don't get to see firsthand, at least, is what it's like from a client's perspective. How much have you agonized over getting to the point before we've even spoken, and then the transaction itself?
I think it's iceberg stuff.
Yeah.
I think 4/5 is thinking about it and 1/5 is doing it.
Yeah.
I don't mean to downplay the vital bit that you do.
No, but that's absolutely right. Yeah. This came up on.
You do the 5th that everybody sees.
Yeah, exactly. But this came up when we did an EOT podcast a few episodes ago. We were talking about EOTs and how it's not the transaction that I probably get most involved with. It's more of like a transition into another period of the business's life cycle. And as you say, the 1/5, 4/5 thing is exactly right. We've known each other for 4 months. I've done that, and hopefully we'll continue to know each other. However,
depends how successful this is, really.
But the business goes on, and you don't need someone like me.
No,
or the business doesn't need someone like me. Every week, month, year.
No. I think I've described it before that you have your advisors throughout running a business, but that's like having a GP who covers most of the eventualities. But then every so often you need a specialist consultant, and I kind of whether it's a surgeon or a cancer specialist or whatever, to continue the analogy. Yeah. And on those occasions, you need to bring in somebody like yourselves who has this particular expertise. But it's a it's a single transactional
Yeah.
activity, I suspect. I don't know. I'm still learning.
Aren't we all? Okay, so let's talk about the transaction itself then. So as we've said, it was 3 or 4 months actually from start to finish of when you actually pressed the button and said, okay, this is what we are doing. Let's go ahead, do it. I mean, we spoke initially, even then we spoke initially about a few different options and what you can do from a tax perspective. And then you went away and thought, okay, well, having that knowledge, what is the best thing? Because I think throughout the process, it was very clear that whatever cropped up, you wanted to leave the legacy of, there's no skeletons in the closet. This is a good company to be at the helm of for the 4 individuals who were, and making sure everything was done right.
Yes, and I think that speaks to this idea of things being seamless.
Yeah.
This needs to be a passing of the baton.
Yeah.
And we've all watched the Olympics recently and seen what happens when that doesn't work out.
Yeah. So, yeah, there were, as I say, we talked initially. Then you went away, considered the options from kind of the tax perspective, and then it was okay. A management buyout's the thing to do. These are the individuals who are going to take over. At what point did you start to involve them in the process? Were they always aware that sort of they were the next generation, or did you kind of say, right, I'm doing this, but it's going to happen at some point, or did they not even know until kind of you'd engaged us and were actually undertaking the?
I should have probably thought about this timeline before I came on, before I joined this. I think I told those directly involved as soon as I was able to. And what I mean by that is that I had enough information about what the process would be that I could satisfy the inevitable questions that anybody receiving the baton would want to be asking. Yep. And that all goes back to the idea of trying to make this as seamless as possible, and without providing any shocks or distractions. Because, and I think that's an important point, distractions.
Yeah.
All through this process, which is a time-consuming exercise, you've still got to be turning the handle, ensuring that everybody else, in fact, all of us, are still focused on generating income and keeping clients. So making sure that remains a primary focus, and nobody's off worrying about this or involved in unnecessary meetings. Everybody's still doing the do, I think, is also part of that seamless progression. So yes, telling people at the right time, once I've got enough information that I can convey how it's going to happen, when it's going to happen, what the steps are that we need to put in place, what the implications are, what the benefits are, how it's going to pan out, portray a picture of what it's going to be like.
So how did they take it? I mean, not everybody necessarily wants. Some people are happy to just be employees. They don't want to take on that kind of risk. But when you spoke to them and say, look, this is what I'm looking to do, I think you are the future for the business. Was it all? If everyone's happy with it, were there lots of questions around it, or any reservations?
Well, I think because I've spent a lot of time ensuring that I selected the right people. Yeah. You would hope that you've made the right selection, so they're not going to be the ones who say, well, I'm not going to do that. Yeah. You're doing what? And that's it. I'm off. I mean, that's not why you would have selected them. So I think that's... I didn't kind of get that response. The response I got and the response that I expected was one of rising to the challenge,
Yeah.
excitement at the opportunities, and people being trying to find the right word. I'm not quite sure grateful is the right word. I'm not quite sure what the word is. That I've placed my trust in them to
Yeah.
carry it on.
Yeah.
All sounds as though it was peachy, doesn't it?
It does.
Yeah.
You're painting a picture that everyone spend a bit of time thinking about it, walking the dog, go and tell them, and it's all sorted.
It's easy, guys. It's easy, folks. Just no problem at all.
But as you say, actually, a lot of that is very, deep thoughts that develop over a long period of time, and that's the reason that you're then in a position to talk to them, and they say that this is exactly what they want, and they're excited, and as you say, they can. You've got the confidence in them, and they've got the confidence in themselves.
Which all comes down to trust, doesn't it?
Yeah, exactly. And it does. Management buyout transactions are very commonly structured that there might be some cash on the table to begin with, either because there's already cash in the business. Some people actually want a bit more cash for their retirement on day one, so the new management team might go away and get some bank finance within the company. But actually, a lot of these types of deals are based on trust, and therefore you defer. So you'd get a valuation for the company, and then you're never going to have that much cash in the company because there's an inherent goodwill. And so typically the trust element is also in the financials because you defer the consideration, normally with loan notes or something, to say, I trust you're going to continue running this business and doing it successfully, so you don't have to go and take on unnecessary risks of bank finance and just effectively pay me when you can, kind of thing, isn't it? So yeah, I guess that's a huge part. That's you're not just placing trust in them that what you've done for 30 years is going to carry on, but you're also placing trust in them that financially they can pay any money that might be due to you, and they can also support the employees that you've been supporting, and as you say, help them pay their mortgages and all the rest of it. So it's a big thing.
It is a big thing, and it's why it needs to be set up properly, because its continuing success is important for absolutely everybody. So coming up with something that absolutely does everything it can to ensure that continuing success is vital.
And hopefully actually continue the growth, not just keep doing what you're doing, but there's now 4 people at the helm. I mean, they obviously already were very key managers anyway, but they're now at the helm to hopefully make it grow even further. So.
Absolutely, take it on even further on new adventures.
So I've mentioned briefly about the different types of transactions that can be done. I've mentioned about EOTs, MBOs, third-party sales, and you just said about making sure it's structured correctly. So when we're looking at structuring things from a tax perspective, and I'm sure we had this conversation to start with, I talk to different clients at different stages of the thought process. So I might talk to someone who then, we have a half-hour call and then we don't actually see for another 2 years because they then go away and do the thinking that you'd already done. But the fact is that when you're doing a succession plan like this, you could be thinking, okay, well, I'll sell and do an EOT, which is an entirely different business model. And I think we talked briefly about EOTs to begin with. The problem the thing that kind of gets under my skin a bit is people who aren't too involved in employee ownership sell it as a tax planning scheme more than a business model. So, you could have sold to an EOT and paid no tax whatsoever, but you clearly knew that the management team that was in place, and Catherine coming in.
You tell me that now. I'm sure you didn't mention
We definitely said it.
Oh, did you? Oh, okay, good.
But that's almost placing even more trust in them to say, look, you are the people. So yeah, I'm structuring it in this way because I know you are the people, and this is the model that's going to help the business succeed the most. And therefore, you're not necessarily structuring it in the best financial way for you, because again, even with an EOT, there's going to be deferred consideration, so that has to work as a business for you to get any deferred consideration out anyway.
So I think my response to that is that, yes, you're right. An EOT would have been financially more beneficial to myself. But if I return to the point about it being seamless and there being a continuance and not delivering any shocks, idea has always been structured on the fact that there is a small team making the key decisions.
Yeah.
And idea has already, as long ago, had a B share structure whereby all employees are benefiting from dividends on an annual basis. And that model, which I suppose is maybe some kind of sort of hybrid model, has worked extremely well.
Yeah.
And everybody understands it, and it is delivered growth and it is delivered profits. And if it ain't broke, don't fix it. It has done well. So going down an MBO maintains that structure rather than delivering a new structure. So therefore, why, if the continuance and ongoing success is a benefit to everybody, why would you change that?
Yeah.
For some short-term gain?
Yeah, exactly.
Probably not a good idea.
No, not at all. And actually,
in my circumstance,
yes, I was going to say, because an EOT is an employee ownership trust is a form of tax relief. Employee ownership is kind of an idea that is much wider ranging, and you almost have a type of employee ownership anyway, because of how you had already incentivized and rewarded employees.
Yes.
Which is why actually I thought it was an interesting way to go, because you've got these 4 individuals who are going to be key, and as you say, you kind of, why upset the status quo on something that's working well, just for a tax relief, because you are still, in a sense, within the employee ownership model. It's just, it's not held by a trust; they're held by them.
Yes.
As individuals, which is sometimes refreshing compared to some of the other business owners.
I think we would have ended up making something very complicated.
Yeah.
And which would have, wouldn't have led to an easy baton transfer, I don't think.
No. As you say, really, actually, my side of it in dealing with the tax is it's a snapshot in time, whereas obviously what we're actually trying to do is set up a business. Well, we're trying to do numerous things. We're trying to set up a business to carry on running successfully. Then we've got Jamie looking to support retiring shareholders in ensuring they've got what they need, as you said, Jamie, earlier, to fund the lifestyle that you want in retirement. And so if you can get a position where everybody wins, that's kind of what we're trying to get to, isn't it? Okay, so the transaction that we ended up doing, how did you think it went? I mean, obviously, you were still working up until the day of completion, weren't you? So,
yes.
Did it take a lot of your time to kind of deal with solicitors and tax advisors and everyone else, or did you kind of just sit back and go, they know what they're doing, I'll just answer their questions as they come in, kind of thing?
I think it did take a lot of my time as it built up to the crescendo of the completing the deal. I mean, I'm sure it'd be convenient for this podcast for me to say, no, it was absolutely fantastic. These guys were brilliant. They took everything off my plate. I had 1 or 2 calls and it was all wrapped up for me. But
that's what I was hoping you were going to say.
I know that's what. But amazingly, life isn't like that. And especially when, you're as heavily personally involved in it and invested a lot of emotional capital in ensuring that everybody is looked after in order to ensure that outcome. You need to put in the effort and the time up front to make sure it all goes smoothly. And these things, you're dealing with, we all do it. We're all dealing with people.
Yep.
And, there's strangest folk on some occasions, especially in new situations and, sometimes pressured situations.
Yeah.
And so it does need a lot of management time to make sure everybody's on board, content, focused, everybody's doing the right thing at the right time.
Yeah.
But yeah, all things considered, I think it went as smoothly as one could hope.
Yeah. And management buyouts
I don't know, what did you think of us as a client?
Good question.
It goes the other way, doesn't it?
Yeah.
Did you end up having to spend a lot of time because we were a really tricky outfit?
I wouldn't have called you tricky, and you were always on top of things, which is quite important when you might have other transactions where the client is sort of less focused and more involved in the day to day that they can't necessarily devote the time that they want to make sure they've got a set of legal documents in front of them. They have to. I mean, how many legal documents you get in just even friendly MBO deals. So
this was a friendly MBO deal.
Yes.
Yeah.
So yeah, and again, that's another reason for doing the podcast is as a tax advisor and not having been involved in both running a business and having to do tax advice at the same time. You kind of think how by doing the MBO transaction and by you having to invest all your time in speaking to solicitors, speaking to me and speaking to the buyers and everything else, how much of an impact is that having on business? And I think when Pete merged with us a few years ago, that was one of the things that I think he's always said, like he maybe didn't fully appreciate from even doing 30 years in tax advisory that there is a lot more involved than maybe you necessarily even expected, because there's all different advisors in the mix. I mean, as I say, MBO transactions generally don't have huge amounts of due diligence and things like that, where you never got a 150-page due diligence questionnaire, did you? So that was one.
No, missed that
one. But yeah, so MBOs generally are more straightforward in that respect. But I mean, how many advisors did you have involved? You still had 4 or 5 at least. When normally the buyers, even at a low level, have their accountants involved, or sometimes they engage their own solicitors. And,
I think I deliberately tried to keep it as tight as possible.
Yeah.
I mean, inevitably, the more people involved, the more complicated it is. But I think we tried to keep it as tight as possible, and as efficient as possible. I mean, I think the kinds of people who are doing this, who are in running companies and are in my position, are working long hours. They're working out of hours. Yeah. I think the fact that I could text you, you'd come back, I could call you out of hours. I think that was enormously useful in the process.
Yeah.
That it's not just if I say a professional a relationship, it tends to suggest it was an unprofessional one. What I mean is that it worked within. It wasn't a 9 to 5 activity.
No.
And I think that's important in trying to work your way through these things. I'm just trying to find a way of,
Finally a compliment.
Finally,
No, but I mean,
but it's important because it breeds
Yeah.
trust, and trust
Exactly.
is vital to getting these things over the. Everybody wants a trusted advisor,
yeah,
and there was yourselves, there was solicitors. There's obviously, I should make a call out to Aura Sabasi that introduced us in the first place. But it was a reasonably tight group.
yeah, and which is good because we ended up completing at the end of the month, and even that was getting to. I think you touched on it earlier, getting over those final hurdles. There's always something, whether it's sort of,
It would be amazing if there wasn't, wouldn't it?
Well, exactly.
Yes.
How nice would it be if every transaction we did was just straightforward and we'll complete on this day?
Well, we wouldn't need people like you, would we?
No,
So
you
you'd be out of a job.
At least I've got a job, yeah. But yeah, I mean, it's sometimes those final hurdles of actually getting from. You spent 18 months thinking about it. Then we've gone away for a couple of months. We've got the clearances. We kind of know the basic structure. We've communicated to the management team taking over. But then we've still got little bits and pieces that need sorting. And I don't think I've done a transaction where there isn't something.
Nope. Always expect the unexpected. And, let's not forget it was an MBI as well as an MBO.
Yeah.
So we weren't making it easy for ourselves.
Well, no, but at the same time, as you say, there's a lot that you did in the background which did help the process an awful lot. And from a tax advisor's perspective, I can do my best to structure it in the best way, but you still need those directly involved to kind of put a lot of time and effort in. And I think as tax advisor, if you'd already retired and were just saying, I'm just trying to get rid of my shares now, it would have been a different story, wouldn't it? Because you would have just been at home being able to do that. But very rarely does that happen. You're normally
in the thick of it.
Yeah. And that's where kind of the communication becomes key, as you say.
Yeah.
So if you want to know how I thought it went, I thought it went quite well.
Good.
We always resolved anything that came up very quickly.
Indeed.
And we had some good solicitors helping out as well. And they were always on top of everything as well. So I think you're right. It's making sure. Obviously, you made sure the team taking over your business was the right fit. It's also making sure you've got the right fit of advisors.
Yeah.
And people you get on with, because I thought we got on really well.
Yeah. No, I do.
You might think differently, but
no.
So, and I think that's important. There's different characters out there that so some people might be suited to other people's personality better and work better with others. But as long as you say, it comes back to the word trusted. We've used that pretty much throughout this whole chat, haven't we? And I think that goes throughout everything that's involved in the transaction.
Absolutely. You need the right chemistry, which then breeds the trust, and with the trust you can do great things.
It's interesting though, because this is the first time we've met in person.
It is. It's been a complete shock for me.
You're not even that far away. You're
No,
far enough away.
3 feet.
But yeah, we do an entire transaction and build that level of trust.
Yeah.
But I guess it's good because obviously pretty much every time we did have phone calls as well, but we did a lot through Teams and and that helps. But sometimes it's nice to actually just shake someone's hand and speak to them and whites of the eyes and that kind of thing. So so sometimes it's quicker to build that trust, I think, when you have being in person, but it just doesn't happen every time. And in fact, a lot of our transactions don't, because we tend to support people up and down the country.
Yeah.
So it's not so easy, but it's refreshing.
Yeah. No, and I think, the one good thing that probably came out of COVID was that we can all operate online, and different generations. We've got clients all across the UK, and it's good for the clients because, as you say, you want to go and seek a specialist in their respective field, and there's no geographical restrictions anymore. You can go and seek a specialist advisor in whatever field and communicate. Don't necessarily need to be going to your local, accountant, local solicitor, local advisor. I
think a lot less people. So the chain tends to be. So let's take the your transaction as an example. You do the thinking. You'd already spoken to Warris obviously quite a bit as your advisor. He introduced us at that point to talk about how to structure things from a tax perspective, and then you normally get introduced afterwards to a solicitor. And it's most of the time, if a client says, "So do you have people you can recommend?" and I say yes, they're not that bothered about where those solicitors are located. Again with the solicitors you use, everything was done virtually. We had plenty of Teams calls, so the communication was still there. So it almost doesn't always matter. It's nice, I think, and sometimes when you're doing everything over Teams, you kind of think it's nice just to be in front of someone and actually building that rapport. It's a bit different.
I think if at any point I thought it was not going as well as it could, then we would have probably got together.
Yeah.
I'd have probably said, why don't I come across? We need to just sort this out, and it'd be good to do it face to face. But I think, so that's always a fallback, isn't it?
Yeah,
but I think it's a kind of a testament to how well it worked that we never got to that point.
Yeah.
And so we were able to continue at the virtual level and texting and calling and but if it hadn't been responsive, if you guys or Wilkes hadn't been responsive enough, then we'd have probably had to have a meeting. But that would have been because of a potential failure.
Yeah. So thank God we didn't get there.
So we didn't do that, folks.
No, I think that's it's just interesting to get a perspective from someone who's been through this and sort of what's involved that maybe a tax advisor doing a single transaction doesn't necessarily appreciate. So what about since the transaction? So it's been, where are we now? Middle of September. It's been a few months almost. How's it been? Because you mentioned earlier that you have been a bit involved still, even though you've retired. You still.
I give some advice and guidance when it's asked for, but it tends to be on the kind of nuances of client relationships, or who was that person, or did we deal with these people before? So it's it's a very gentle touch on the tiller on the odd occasion.
Yeah.
It would be I would hate to be in a position of being some kind of backseat driver. Otherwise, what's the point of having given everybody handed it over and given everybody else the responsibility?
Yeah. I can imagine actually, as if you've run a business for 30 years, it'd been almost difficult to kind of say, but clearly from your perspective, it's almost, is it a relief that you've decided these are the people to take it forward, and clearly they are so far doing exactly what you expected.
I don't think I'd say it was a relief, because if I say it was a relief, it makes it sound as though it was a burden that I was keen to jettison, which is not the case. It was just that the time was right. You've got to go sometime.
Yeah.
You can't go on forever. So you've got to go sometime. So trying to find the right time is the important decision, and it's an unknown quantity. You can't define it. You just know it when it's there. So consequently, I wouldn't say that it's relief. It is a natural progression for me, as it is hopefully a natural progression for everybody that is left within the business.
Yep.
And at the moment, I'm quite enjoying the one missing element that I had during my working life, which unsurprisingly is time. So I'm quite enjoying the novelty of time.
Yeah. Yeah. One day, maybe we'll get the same.
Maybe.
Young kids into work and
you will.
everything.
I'm
It's
sure
all,
you will.
it's all good fun as well. So.
Yes.
Okay, so I guess just a quick finish off. We've kind of covered a lot of what I wanted to kind of talk about in relation to once sold, because Jamie, I was going to come back to you and talk about, okay, well, in an MBO transaction, as we've said, you normally end up with a decent amount of cash, or you might have deferred some, but you said earlier
like
about...
you say normally, it kind of it excludes me then.
But you said earlier about the inheritance tax position and the fact that, and hopefully someone's told William this bit as well, you've gone from having a BPR qualifying asset of whatever your shares were worth to now you've got cash, loan notes which won't qualify either. Mm-hmm. So everything you now have is exposed to inheritance tax.
Yeah, that's it. And people, when they exit or sell, a lot of them have different views. Some people view inheritance tax as the tax that, you know, their beneficiaries will pay, so why should they worry about it? Yeah. Other people, you know, it's the last thing they want to do. They feel like it's double taxation. And inheritance tax really is one of those where, with good planning, it can actually be voluntary in the sense of the inheritance tax that is payable upon your estate. Just to take a step back, each individual can pass £325,000, which is known as the nil rate band. If you leave a share of your main residence to, you know, a bloodline child or dependent, then you would also benefit from an additional £175,000, which is known as the residence nil rate band. So for a married couple, therefore, you can typically pass £1 million free of inheritance tax, and then anything over and above that is liable to 40%. And there's a number of ways that can be mitigated. You can spend it. It's known as spending the kids' inheritance. You know, if you're over that threshold, everything all of a sudden is on a 40% sale. So go and book that business class flight.
I've not thought about it that way.
Yeah, go and book that business class flight or round the world cruise. You know, it's a great sale. Mm-hmm. Obviously, you can make use of your annual allowances. You know, each individual can gift £3,000 per annum. Yep. Married couple, £6,000. You can also use the allowance from the previous year. You can do further outright gifts up to the nil rate band typically, which can be done periodically every 7 years, and then they fall outside of your estate. So this is typically where the sooner you start, the better we can plan for. Yep. You can also take out insurance. So dependent upon the health and the age of the individual, there would be a cost to this, but there could be a whole of life cover policy set up on second death, which then matches the IHT that's payable, or we project it forward. That it depends on the age of taking them out and the medical conditions, but that is an option. Trusts is another. So instead of making outright gifts to your beneficiaries, you may want to retain some control, or you may wish to retain some access, and there's lots of different types of trusts that all come with differing tax treatments, flexibilities in terms of control, access. So that's another option. And finally, investing. This is more considered higher risk, but similar to owning a share in a trading company, you can invest in BR qualifying or business property BR qualifying investments. And when they're held for a period of 2 years, they're then considered outside of your estate. And one current quirk is that if you've sold a business, you get what's called replacement relief. And so actually, as long as that investment is made within 3 years, then it's automatically qualifying, and you don't have the 2-year window. So there's lots of different levers and tools that we can use, and it's, we're not product salesmen. We're actually look at everything holistically. And the last thing we want is for somebody to sell or exit their business and jump straight into making decisions about what they want to do with their wealth. It's actually walking your dog for another 3 months and thinking about what's important to you, and just ensuring that what you have built is protected. So typically we'll find that proceeds come into the individual's bank account. They're not used to seeing that number in their personal bank account. They might see it in their company bank account, and they just freeze. They don't want to touch the money. They're scared to touch it, but actually it probably exceeds the FSCS deposit limits of £85,000. So it's all about structuring it, not only for protection, but also to ensure that it can provide an income in the future.
Yes.
And then if there's any to support the future level of income in real terms in today's money, well, then we probably do need to consider investing some of those funds, because the reality is cash offers a guaranteed return, but evidence shows us over a multi-decade retirement or period that will be a sub-inflation return. And so, I think the average price of a beer back in 2004, heard it on the radio the other day, was £2.04.
Crikey.
And so if you want to be able to buy the same amount of beers with the same amount of money, well, that's when you invest in a blend of the global companies of the world and other assets, which evidence shows us will outpace inflation over the longer term. But it's all about structuring it correct on day one. And then, not tinkering with the plan, having annual planning meetings, reviewing if there's any immediate or sudden changes to circumstance, and just reviewing it there.
I can remember when beer was 28 pence a pint.
What year was that? I need it for the next podcast.
But we've got the business transition, which we've spent most of the time talking about, going from one ownership doing the transaction and then a completely different ownership. And there's also an entirely separate shareholder level individual transition, going from you're on a salary, maybe some dividends, to having cash and other investments, and kind of funding your lifestyle in a different way. But it's kind of the same principle, that it's another transition that you need to kind of manage.
It is.
And I think obviously from what I do, a lot of clients I help doing that one thing, and I don't necessarily in any way get involved in what you get involved with, which is the personal transition.
And we're here as a sounding board to clients when they're making big financial decisions. One thing that I always see a lot of in business owners who have sold is, yes, they've been really successful in their business and they've built it, but all of a sudden when they receive proceeds, they then all of a sudden think that they need to get involved in another small business where they maybe don't have the knowledge, experience, expertise. And the reality is the majority of small businesses fail. And so it's very important to protect and preserve your financial fortress in terms of the proceeds, and structuring it properly. And that's through, typically an emergency fund, a rainy day fund, retaining ample years of cash to meet short-term expenditure, and then to provide income. It's about structuring it in different tax wrappers, ISAs, pensions, offshore bonds, which have different tax treatments, where 5% can be withdrawn tax-free each year of the original lump sum amount, and other types. It's about having multiple taps that you can turn on to not only grow your money, but then any gains in the value of those accounts in the future, we can utilise an individual's allowances for each of those. So
good. Okay, I think that brings us nicely to the end. So all that's left for me is to thank you both for joining me. It's certainly been interesting to me in understanding kind of the different side of things as well. So appreciate your time on that. And thank you everybody for listening, watching. hit the like and subscribe as always if it's been of interest and you want to hear more. And hopefully, we'll catch you on the next one. Thanks very much.
Thank you.